There is a new viral conspiracy theory trend on social media where people claim all major corporations and even entire industries are owned by the same group of people. The conspiracy that few individuals around the world is as old as time, but this one is openly naming the culprits that actually exist.
Blackrock.
Blackrock?
Blackrock.
Blackrock.
Only Blackrock.
Joe Biden.
So according to the theory, BlackRock owns almost all of the biggest corporations across the globe. They own the big tech, the big pharma, the big everything, the big dingus, and the mainstream media.
And mainstream media.
This insinuates their hidden influence and supposed secret agenda they allegedly enforce on the corporate world. But like with most conspiracy theories on social media, this one is easy to dismiss.
I will eat you.
BlackRock is indeed among the largest shareholders in the biggest corporations across all sectors of the economy. This isn't hidden information. Anyone can pull this up from publicly available sources. But the catch is that BlackRock doesn't legally own anything. The $10 trillion in assets they have are under management on behalf of their clients. So the real owners are the people. No, not like that. BlackRock's clients are companies, pension funds, institutions, or retail investors. Anyone who has decided to invest into stock market through BlackRock is legally and technically the owner of the equity managed by BlackRock. So if BlackRock was to go bankrupt, assets would be liquidated and paid out to their clients. But is that really all there is to this story? My natural curiosity made me want to check what the academic research had to say about this, and what I found has actually blown me away. As it turns out, the issue of BlackRock's power and influence has been very well studied and analyzed by economists for years. It isn't just about the raw numbers on the ownership lists of big corporations. Economists found that many major problems that plague our economy today can be directly attributed to the concentration of economic power by BlackRock and the like. Stagnation in innovation, rise of consumer prices, decreasing wealth of the working class, even income inequality. I am a strong proponent of the notion that there is no need to believe in conspiracy theories. Rational explanation is most of the time bad enough. So please join me on this ride. We are about to descend to hell and we only bought a one-way ticket. How big are they? While BlackRock is a focal point of the conspiracy theories, economists actually include two other similar firms in the same pile, Vanguard and State Street. Researchers call them the Big Three. All three companies are passive investment funds, and they grew from insignificant in the equity market just in the middle of the 1990s to essentially becoming the equity market by 2010s. The Big Three together hold a frighteningly monumental position in the corporate world. Today, BlackRock, Vanguard, and State Street control more than 80% of all assets managed by index funds. Their average combined stake in S&P 500 companies more than quadrupled since 1998. If that doesn't sound consequential, the Big Three constitute the largest shareholder in 88% of the S&P 500 firms. The combined value of all assets managed by the Big Three sits at around $20 trillion, more than any other shareholder anywhere in the world. To get a better perspective of their powerful stake, look at this list of the top 15 global block holders of corporate ownership from 2016. BlackRock and Vanguard have by far the highest number of 3% as well as 5% block holdings, with State Street not too far behind. Block holders of 5% are considered highly influential. Block holders of 10% are considered insiders according to the US law. No other shareholder has stronger position than neither BlackRock nor Vanguard. To illustrate this even further, there were about 3,900 publicly listed corporations in the US in 2016. BlackRock had more than 2,000 5% block holdings in the US, more than half of all listed US corporations. Who are they, and where did they come from?
Where's the money, Lebowski?
There is absolutely no denying that these investment companies, that very few people have ever heard of before, suddenly came to become the most influential shareholders on the planet. But they didn't spawn out of nowhere, and they haven't always been this prominent. Economic researchers have been studying their sudden surge for years, and this is what they found. The Big Three are a relatively new financial innovation that started with the creation of Vanguard in the 1970s. In that time, investing was often costly and quite risky. Most asset managers were rather active, seeking to game the market by carefully picking winners and weeding out losers. This in turn meant higher costs for asset managers due to more extensive and resource-consuming research that investors needed to do to pick the right stocks. The asset managers would offset these costs on their clients in the form of portfolio fees. But then, Vanguard came in with a competitive idea. Rather than spending all their time and resources to find the most winning stocks, Vanguard's investment strategy would be passive. They would invest into index-based products with industry-wide reach. They weren't looking for the best horse in the race, and they weren't pushing their companies to crush the competition. They were looking to build a diversified portfolio of assets with guaranteed returns as cheaply as possible. Now, with such a passive investment strategy, Vanguard no longer needed to spend resources on extensive research into specific companies or invest into managerial stewardship to improve performance of individual firms in their portfolio. This allowed them to lower the fees far below what actively managed funds would charge. At first, Vanguard was shunned and ridiculed. For one thing, their strategy was considered un-American because it would invest into winners and losers sort of equitably, rather than chasing short-term profit by pushing the winners to undercut their competition. But Vanguard's low fees were undeniably attractive, and soon their passive strategy proved to actually be more effective. While active investors would rarely outperform the market, if at all, passively managed Vanguard guaranteed stable returns at the lowest fees in the industry. In the following decades, the United States oversaw some dramatic pension reforms that encouraged companies and retirement savers to flock their pension funds into the cheapest asset portfolios with the most guaranteed returns. Along came the modern portfolio theory that successfully argued for diversification. So by broadening their portfolio, an investor would get more diversified, which would increase returns, lower the risk, and spread the cost of research the larger the portfolio. Modern portfolio theory was the theoretical approval passive investment funds like Vanguard needed to win over the financial crowd. And just like that, Vanguard turned passive mutual funds from a ridiculed concept into a synonym for good financial advice. How can they control things? And now, the Big Three manage $20 trillion in assets worldwide. With that kind of power, what are their mechanisms of control? Shareholders that own voting shares have the right to participate in regular shareholder meetings where they can vote on proposals that direct corporate decisions or elect members of a company's management. Despite not technically owning anything, it is the Big Three that votes on behalf of their clients and their portfolio companies. Clients are still the owners, they just don't vote. All of the voting power of the Big Three stock holdings is thus concentrated within the central command of the three investment firms. This is where things get interesting. On average, the combined stake in S&P 500 companies managed by the Big Three is above 20%, which already makes them the largest single block holder. But their voting power is even greater than that. That's because not all shareholders who can vote generally do so, but the Big Three do. Their 20% shareholder stake at any given company can thus represent about 25% of voting power. Research predicts that the Big Three's voting stake will rise to 34% within the next decade and to 41% within the next 2 decades. These aren't exactly controlling stakes, but they still translate to significant influence. A research by the Cambridge University found that the Big Three do coordinate their voting strategy and generally act as a bloc that can sway the support for or against proposals and management elections. Researchers analyzed the Big Three's proxy voting, and they found remarkably high rates of internal agreement. Compared to their actively managed counterparts, the passive managers overwhelmingly vote as a single consistent unit. Another mechanism of influence is direct engagement, phone calls, texts, or meetings with corporate representatives outside of the shareholder meetings. The management cannot go against what the shareholders officially voted on, but it is in their best interest to be on good terms with their investors. And the larger investors realize this potential. Up to 63% of large institutional shareholders have directly discussed corporate decisions with management, and up to 45% of them have had private conversations with the company's board outside of the management. This is the case for all institutional investors broadly, not just the Big Three. But given the Big Three is often the largest shareholder, they're most likely to have the ear of the management at most companies they invest in. The third method of investor influence is pulling out. The same principle applies. The larger their shareholder, the more severe the impact on the share price. If the Big Three collectively decide to sell their shares at a company, it could have detrimental consequences to the firm. According to a 2015 survey, about half of institutional investors consider exit as a viable strategy when they are dissatisfied with a company's performance. Now that was how they could exercise control. But how do they actually exercise control? During an annual shareholder meeting at ExxonMobil, an activist shareholder successfully pushed the oil giant to adopt a policy to reduce their carbon footprint. This event instantly made big headlines, mainly due to the fact that a vote wouldn't have gone through without the unanimous support of the Big Three, who had sided with the activist and voted against Exxon's leadership. The reaction to this news was ecstatic. Everyone involved took the opportunity to argue how big institutional investors exercise their power to push companies to do their bidding. BlackRock, Vanguard, and State Street signed onto a promise to agitate their portfolio companies toward reaching net zero greenhouse gas emissions by 2050. A noble goal indeed. BlackRock was praised for supporting up to 47% of social and environmental proposals, which is a weird way of saying they still rejected most of them. But then, all of the enthusiasm quickly died down when BlackRock announced they would vote for fewer climate proposals because they don't want to micromanage companies or challenge their business models. Several groups analyzed the Big Three's voting record, and they all found an overwhelming rejection of climate proposals, with support for them no greater than 27% and as low as 10%. For a long time, economists thought that higher concentration of asset ownership among fewer individuals would result in more coordination and active monitoring. In other words, the fewer owners and the larger their position, the more desire they would have to exercise their influence. But the reality seemed to be the opposite. The Big Three was found to consistently vote along with the recommendations of managers of their portfolio companies. In fact, the management could count on their support 90% of the time. This is not true just for passive mutual funds. It applies to all asset managers in general. What this signals, though, is a large disinterest of passive asset managers in corporate governance issues. When management recommends to vote against an activist shareholder, the Big Three aligns with the managers up to 98% of the time. This means that the main power of the Big Three's alliance with the management is within the ability to repel activist investors. Research shows that a large majority, or a plurality of proposals rejected by the Big Three, are related to environmental, social, and governance issues. The only area where the Big Three are in opposition to the management is when electing the board of directors. The split there is 50-50, which suggests that BlackRock, Vanguard, or State Street use their power mainly to appoint company leadership, and then they align with that leadership. These realities led economists to conclude that the Big Three lack incentives to intervene in managerial affairs. The index fund giants have been found to massively underinvest in company stewardship, while excessively deferring to the managers for corporate decisions. BlackRock's and Vanguard's stewardship personnel and expenses are minuscule compared to the size of their portfolios. Even though they publicly stress the importance of good stewardship, their budgets are almost zero relative to the revenue from fees. Economists provide an explanation for this lack of interest with a zero-sum game theory. If BlackRock wanted to increase performance of a particular company, they would have to increase their stewardship investment, find personnel, expertise, pay for the training. This would increase their total portfolio costs that would be solely borne by BlackRock. If a stewarded company were to improve, though, the benefits would be enjoyed by everyone in the equity market, including BlackRock's competitors. BlackRock, Vanguard, and State Street are so-called horizontal shareholders. Their broad portfolio dragnets created hundreds, if not thousands, of parallel ownership positions. The firms the Big Three invest in are supposed to be in competition with one another. While an active asset manager might want to own shares of Pepsi but not Coca-Cola, the Big Three would hold significant positions at both of them. The active manager might want Pepsi to undercut Coca-Cola on price, but the Big Three would benefit most if they both avoided price wars. Encouraging one company to undercut the other could introduce a conflict of interest that could hurt the Big Three's bottom line. As asset managers, they act as investors in portfolio companies, but they are often their clients too. For instance, companies often entrust the Big Three firms to manage their employee pension funds for them. So the main interest for the Big Three is to seek a long-term performance of the whole index rather than a short-term win of one competitor over another. While it may seem that all economists think that the Big Three keep their hands off of the corporate world, they actually point to several severe consequences such reconcentration of wealth management poses. Because the Big Three doesn't benefit from improving performance, increasing competition, or contributing to social and environmental governance, economists have started to notice significant anti-competitive consequences that hurt consumers, workers, and low-income earners. These theories sparked a little academic war, but the results eventually came clear. A study in 2014 found that airline tickets were 3 to 7% more expensive at companies with high rates of common ownership from big index funds. A similar study in 2018 found the same effect with the drug companies. This academic backlash prompted BlackRock to fund a study to disprove these claims, but upon the following revision of the economic literature, new research solidified the theory that increased horizontal shareholding proportionally increases consumer prices. None of these effects require communication or coordination of pricing strategies between companies or investors. They simply exist as a result of managers seeking to maximize their odds of re-election by big horizontal shareholders. The effect of shareholder voting alone is enough to lessen the incentives for corporate managers to compete. Researchers also found horizontal shareholding has the same effect on the large gap between corporate investment and profits. Rather than reinvesting profits back to the firm, which could create more jobs or increase workers' pay, horizontal shareholders would rather vote for higher compensation to managers and executives. Higher executive pays would be rewarded irrespective of their firm's performance. This gap was found to be driven by high levels of horizontal shareholding within any industry across the economy. The widening investment profit gap also coincides with the growth in corporate profits and decline in labor's share of national income. According to some economists, the sharp increase in horizontal shareholding in recent decades is responsible for the increase in income inequality. The first reason for the income inequality correlation is that corporate profits are more likely to disproportionately go to wealthy shareholders, while higher prices are disproportionately borne by the non-wealthy. The second reason is that low corporate investment depresses wages and employment, which disproportionately harms low-income earners. The third reason is that the rate of increase in consumer prices has been found to be higher in products targeting low-income households. The Big Three may also command what economists refer to as structural power. Structural power seems to be an academic lingo for what the common folk may recognize better as too big to fail. It's when a business holds such a prominent position that growth of the whole economy depends on it. The Big Three has risen to be such important financial institutions that a whole system depends on them to function properly. This level of influence makes firms proactively internalize the Big Three objectives to earn their blessing for the next corporate elections. This structural power is hidden from direct view, but can materialize in the aforementioned anti-competitive consequences: higher consumer prices, disinterest of managers to compete, lower rates of profit reinvestment. Many prominent figures in finance and academia have begun sounding alarms on the power and influence of the Big Three, suddenly claimed for themselves. Even Vanguard's founder, shortly before his death, wrote for the Wall Street Journal a dire warning about the power of index funds. He worried that too many shares may be in too few hands and could one day control the whole US stock market. Michael Berry of The Big Short called index funds a bubble, and the global co-head of Goldman Sachs called it a bubble machine. The worrying consensus among economists seems to be that the Big Three are pivoting the economy from one that used to be driven by fierce competition and market forces to one that is more stagnant, more unequal, and less responsive. It's always difficult to predict the economy, but these are the real concerns with concentration of economic power, and it doesn't require one to believe in a conspiracy theory. This is how the Big Three own nothing, yet control everything. There is no grand conspiracy, no secret agenda, just each snowflake doing what it knows best, slowly piling up into a giant snowball. Maybe it will grow into a beautiful snowman. I know what some of you will type in the comments, but let me be clear, all I want is to get a giant sponsorship from Bill Gates so that I can make a documentary about how effective altruism is a fascist ideology with mathematics as its branding. Patreon.com/TheHatedOne. Thank you.